Hello, hi. Thank you everyone for joining again. Sorry for the disturbance. We will start our monthly market outlook call. We have with us Mr. Aman Chowhan sir, who's been there with Abackus since inception, and he has been a fund manager for almost now 10, 20 years now. He have overall experience of more than 20 years in the equity market. Yeah, so thank you everyone, and again, apologies for the delay. Uh, Aman Chauhan sir, request you to start. Thank you.
Sure, sure. Thanks, Shailesh, and good afternoon, everyone. Thanks for joining in. I head the investment team for the alternate business at Abacus, and uh, it's been some time since we had an market update webinar or a conf call with the public at large, and hence we felt this is an appropriate time to take an overview as to how things are, how markets have been volatile. We all know that there have been some positive surprises, some negative surprises. Maybe we can discuss those outcomes, scenarios, and more importantly, as to what we are doing, how are we navigating the current challenging times, what are the changes or what have we been done on the PMS portfolios, and then obviously the outlook going ahead. So before we start, just to give you a perspective, broadly, this is how the markets have been 1 month, 3 months, 6 months. There is no clear trend, as you see. Some pockets of green, some pockets of red, some months, some time frame. Some sectors done well, sometimes some other sectors done well, some other segment has done well. But meaningfully, if you see, this is what the number is in the last 6 months, which has seen the March fall and the recovery post that. The micro cap segment has done very well, and followed by the small cap segment. Nifty is still negative. Mid and small cap is where the whole action has been, specifically in the last 6 months. In the 1 year basis, also they are done well, but not so well the way they have been in the last 6 months. And the rub effect of this last 6 months is also visible in this 1 year, right? So if this was not so strong, then 1 year also the mid and small cap outperformance would not be so significant the way it is right now. So it's predominantly the last 6 months is when the mid and small caps are done well. From a sectoral perspective, also, if you see recently, pharma is the best performing sector, followed by real estate and consumer durables, which is also something which was not expected 3 months back, 6 months back. Pharma, obviously, biggest beneficiary of currency move. The depreciation of the currency, pharma is one of the sectors that benefits out of it. Besides IT, we have macro challenges. We have negative news flow coming in from the AI world, and there's question mark over the sustainability of a high growth era for Indian IT services company, the traditional IT services company, and hence that sector, even though being a net beneficiary of the currency, has not performed. Pharma, on the other hand, has been one of the best performing sector. Defense continues to do well. Last 3 years, 5 years, if you see the number, this is something that is where the momentum is pretty strong, and that is where things are pretty good. And so has been the capital markets driven companies, exchanges, wealth companies, broking companies, and so forth. 1 year outlier has also been the metals sector per se. So broadly, if you have to give you a 2 to 3 year trend, bearing the near-term volatility, the key winners would be obviously defense, cap good companies, engineering companies is where I believe the clear trend is where the money has been made. Now, the dilemma for an investor as well as for people like us who are managing money is to whether to stay invested or keep on investing in the same defense and cap good sectors, because this sector has now got re-rated. It is trading at north of 50, 60 P now, which earlier used to be 15, 20, 25 P. And now from these levels incrementally, whether it makes sense to keep on investing in this sector or look for other sectors. We at Abacus, we being value conscious investors, we are very clear that we don't want to pay unnecessary premium just for the sake of it or blindly chase the momentum. And hence, we have been very selective in these two sectors per se. We don't have a very high exposure in the defense space. Earlier, we used to have book profits because valuations ran ahead of what the numbers would come in, but the sector continues to do well. Incrementally, on the fringe, we might add some exposure here, but it's not going to be a very large exposure per se for us. So that is broadly on the defense front. On the industrials capital front, we are pretty positive. We are pretty excited because that's the macro thing. We can say make in India manufacturing, which is picking up. This sector is a clear beneficiary. Valuations here are also now on the higher side of the, you can say, average or the standard deviation range for which in this sector used to trade. But I feel we can still make a market return out of this sector. So it's not that this sector is going to underperform in the near term, and hence we stay invested. Metals, we are clearly overweight, high single digit to low double digit exposure across portfolios is what we have in metals. And we have been invested in metal for a long time, not just last 6 months, for the last 3, 4 years. We have been invested in metal. Last 1 year or so, we have increased that exposure meaningfully. Also, one major change that we have done is almost 6 months back, we decided to move out of the traditional IT services companies that we had in portfolio. So, bearing a few product companies or in new age companies, the traditional IT companies we have completely moved out of the portfolio. So that has also helped us in the performance that we have delivered in the near term, especially in the last 6 to 8 months, because this sector has significantly underperformed and we got saved by having no exposure. And that's the benefit of the style of investing that we are completely unbenchmarked, right? So we don't mind if the view is negative, completely avoiding exposure to a certain sector, or wherever the view is positive, having a decent, meaningful exposure within the portfolio. So broadly, this is where the sectoral things comes in. So this is just to give you a perspective as to what has done well, what has not done well, how the markets have been, and what have we done broadly. Now, coming to where the market is right now, and we all know Trump issues, we all know the Middle East issues, we all know 90% of oil comes from Middle East, which is imported, because of which currency has gone for a toss. 87, 85 is now 96, and we all know these obvious things, right? So there's no point further discussing into that. That is something that we read on a daily basis. I try to give you a broad perspective as to how is India placed and how are things working out for India. Now, as far as the country is concerned or the economy is concerned, there's clear overhang of oil, which we all know. Now, when the oil price went up, the government had two options. One, either it passes on the impact to the end consumer, whereby which the retail as well as government shares the burden or the responsibility of the higher oil price, or the government, as it has decided, it will foot the bill itself. Since the government decided it is not going to meaningfully pass on the higher oil price, which meant that they have to pay the bill. Somebody has to pay the bill. We continue to consume petrol, diesel, and oil and gas on a daily basis, and nothing much has changed there. But the price has gone up 30-40% since March. So somebody has to pay this higher bill, which the government for now is footing the bill. And the impact of that is visible in the currency. What happens is that now you need to pay much more dollars than what you earlier had to pay, because of which there is a higher dollar demand, which also impacts your currency. Second, the government also has fixed budget. We run a fiscal deficit. We are not a fiscally surplus state or economy as such, right? So, if government has to pay more for oil, somewhere it has to cut, or else it has to print more money. If the government prints more money, then there is inflation. If there is high inflation in the country, then the impact of that also is visible in the currency, right? So this is some of the factors that has impacted the currency, predominantly triggered by one, the tariff, as and then followed by the Middle East crisis. So in spite of all this, we feel the government has taken the right decision, that it has decided to foot the bill itself, so that the retail level inflation is under control and the retail level demand is also under control. And this is something which we feel in the long run, in the medium also, in the medium to long run, is going to be very, very beneficial for the country. Because what would have happened is if the government decided that, okay, let me pass on the oil hike to the end consumer, then the ground level demand gets impacted. The currency wouldn't have gone to 95. Maybe it would have depreciated from 85, 85, 87, 88, or 90 levels, but not 96 levels. Currency would have saved, but the whole momentum that was building in the economy with the growth rate was accelerating because of the big decision the government has taken in the last 2 years, which was the GST rate cut, the tax rate cuts, the tax benefits that the government has given, the benefit of that would have got nullified. And hence the government has taken this call that it's okay, we'll take a near-term risk on the currency, but we don't want domestic demand to get impacted. Whenever the Middle East situation gets resolved, whichever way it gets resolved, uh, we feel oil has to come off. It might not come back to the $50-$60. Maybe it's still in the 60 to 70 range for in at least in the near term. But even if that has to happen, then overall we feel the economy will be able to accelerate further because the ground level damage has not happened at all, right? So you and I still continue to consume the way we used to do before March. Hence, domestically demand has held down. So that is something which we call as the macro resilience. That the macro positive India that we always discuss, demographics, population, underpension, that is something which is now really getting reflected in where the numbers are. If you look at the high frequency numbers, the monthly numbers, GST collection, income tax collection, your electricity generation, your credit growth, everything is pointing out towards acceleration, everything is pointed out towards things getting better on the ground, right? So the demand is holding on. Because of this, the first quarter, the recent quarter numbers which has come in has also surprised on the positive. People were worried that the March impact will be visible. We have been telling this to the clients that in the March quarter, not much was visible because it was just a 1 month impact in the March quarter, and the real impact of that Middle East crisis will be visible in the first quarter. Thankfully, and to a positively surprised most of us, that the first quarter numbers have come in better than what the street is estimating, both on the top line as well as on the margin front. Yes, there has been some inventory gains. Some companies have benefited out of this. Some companies didn't get impacted due to higher freight or volatility in the raw material. But more or less, they were able to pass on because the demand has remained resilient in that sense. So, first quarter numbers clearly on the higher side than what initially was the expectation. Maybe second quarter see slightly more impact than in the first quarter because by then the old inventory and the gains that somebody had would wane off. But still, overall looks like that 15, 16, 17% kind of aggregate earnings growth that people were expecting at the start of the year before March. That is something that can happen, is what we feel. Maybe not 15, 16 times, but even if it happens around 11, 12, 13%, that should be good enough. So that corporate earnings is, you can say, quite resilient. The third thing which has been, you can say, having a very significant bearing on this market performance and the which sectors or stocks does well has been the domestic liquidity. If I just share some data with you, this is how the liquidity scenario looks like. On your left hand side is the FI numbers, on the right hand side is the domestic liquidity numbers. Let's first discuss FI numbers and then the domestic liquidity. As far as FIs are concerned, it was a record selling in month of March, obviously. Post that, also we have seen decent FI outflows going out of India. Two reasons. Globally, AI and data center are the buzzwords in the market. This is what the sectors that are doing well, and investors are making huge amount of returns and money in these sectors. If you look at markets, not just India, globally, over the last several decades, you will realize that every 2 to 3 years there is some theme in the market wherein certain sector or wherein certain segment of the market does extraordinarily well. There is momentum, there is euphoria, and things are looking very positive for that segment for 2 to 3 years until a new sector comes in. 25 years back, Y2K era is when IT companies were doing very well. Post that, there was a phase when pharma companies did well. Post that, there was a phase when even utilities or power companies did well before the coal scam broke out in India. There's a segment like MNC companies did well for a few years. A few years back, new age company was a buzzword in India. IPOs came in. You had the likes of your Paytm, Zomato, Policy Bazaar, Eternal to whatnot. All these companies got listed. For the last 2.5 years, defense is the buzzword. And in the last 1 year time, AI and data center is a buzzword globally. AI and data center is not that big a buzzword in India because we have very few companies that directly benefit out of this. At best, we have few ancillary companies like a power cable companies or transmission companies or power T&D company which benefit out of this, or maybe one or two civil companies which sets up data center. But globally, this is a very big theme right now. There's huge amount of billions and trillions of dollars getting invested into the data center. There's a mad rush to start data center. Now, to give you some perspective, why is this so? Suddenly, what has changed, right? Ultimately, what is data center? Data center is your cloud storage. What you earlier used to store in your laptop or your PC or on your phone, now that is getting saved more and more into the cloud. Whether it is OneDrive, Google Drive, or AWS or whichever company you choose to, but it is all getting saved on the cloud, right? So it's not a big, it's something not something which is new. Post-COVID, digitalization and cloud were already the buzzword. Companies, individuals, they are all moving towards cloud services. So it's no longer a surprise that AI and data center has suddenly become a buzzword. The key reason they have become a buzzword is because of the AI thing. When the AI modules first got launched 6-8 months back, people realize that what they're claiming they're able to deliver. And ultimately, what is AI? AI is faster processing. When you go to Google Chrome and ask them something for Google, that is also kind of AI because the Google gives you an answer looking at trillions and trillions of data globally, and then within seconds it picks up the answer for you, whatever you're searching gives you an answer. The AI modules go 3 or 4 levels deeper. They can further based on your inputs, dig deeper from the output. They can even collate the output for you, compare the output. They can even design the output that you want. So whatever search you did on Google, say give me a certain map or give me a certain distance or something, that the AI today is now capable to first compare it whether air is better, road is better, which route is better, with Google Maps is doing, but AI can do it efficiently across platform and also make a PPT for you or make it a doc file for you, make a note or a report for you, right? So this AI modules, when people realized are working efficiently, it was writing on the wall that the data computing has to now get much more faster than what it used to be. Because earlier there was only one Google search. AI is going 5 levels deeper, so we need 5x more processing speed. And more data will get compared, more and more data needs to be stored, and hence there is this mad rush to get into more and more or bigger data centers as early as possible before the technology changes. Because technology here also rapidly changes. Every 2 years, you have a faster processor, you have a faster storage device, and things keep on changing. Hence, people want to invest into data centers before the technology changes. Because if the technology changes rapid, then the later stage capex or the spending a corporate will do to set up a data center becomes redundant. So the earlier you are ready, you have been able to generate good margins, good profits, your payback is faster. The more late or delayed you are in setting up a data center, you run a higher risk of technology obsolescence or technology upgrade, and your cash flows will not be that strong to be able to justify the kind of capex that you're doing. Because of this huge demand, and globally investors are now chasing AI and data center stocks, and that is and India doesn't have much play in there. In fact, we are negatively impacted because this AI is indirectly and in certain extent even directly impacting the traditional IT services model that we have. And IT in India is the second largest sector after financial. If you look at Nifty, IT is the second largest sector. It has been a pillar of strength because the kind of employment it has been able to generate across the middle class of India and the young population in India, and that is what is driving the consumption growth of India, right? So with these companies getting impacted or the job growth in these sectors getting impacted, clearly there is going to be some impact on the consumption. Also, in a way, not just India is not benefiting or directly getting positively involved in the AI data center, it is in fact negatively getting impacted. And this is broadly what the FI numbers show that. Hence, they have been taking money out of India and getting into the new age sectors. There's also one big change that has happened in India. When FIs invest into India, they obviously invest bulk of the money, if not all, into the obvious popular leading names of India, right? And what are these leading companies of India? HDFC Bank, Kotak Bank, Infi, TCS, Reliance, Bharti, Page Industries, Bajaj Finance of this world, right? If you look at the performance of these stocks, The last 5-year return of HDFC Bank and Kotak Bank is zero. Infi and TCS is also zero to negative now. Even Reliance is zero, and so is the case with Lever, ITC, and many such companies. So what has happened is while the mass market in India or the mid-market investor in India made decent returns, the large obvious names investor, which was bulk of where the FI money is, these guys have not made return over the next last 5 years, not just 1 year, 2 years, in the last 5 years. And what I'm talking so far was in INR terms. In dollar terms, so they are negative 20%. So if HDFC Bank 5-year return is zero for you and me, for an FI it is minus 20%. Right. That's a huge change in the kind of investor return profile these FIs used to make. There was a long period of time when India was amongst the best performing markets. We were relatively always in the top quartile, and that has changed. In CY25, India's relative performance was the worst in the last 20 years. On an absolute basis, the Nifty still gave you a single digit return, which is not bad considering the previous 3 years the returns were quite good. But on a relative basis, other markets did much, much better than India, and hence we were relatively underperformers in that sense. So this is what has triggered the, you can say, disinterest or profit booking or change of mindset or removal or getting this capital out of India and moving it more productive somewhere else. This trend continued for a good 4-5 months, and post the relative underperformance and the currency hit that we have taken so far, now on the fringe we are seeing FIs coming back, or at least the selling has stopped, and on the marginal they have come in with a positive number in the month of July so far. Why has this happened? I believe the relative underperforming chasing companies or funds are now looking back at India because one, the risk of FI currency depreciation is now behind us. What has happened, bulk of it has already happened, the damage is already done. 96, 97 is now not going to 110. Right? So bulk of the currency pain is already behind us. Growth numbers are held on onto India. We all know the Trump tariffs are not something that is going to be long term. He is facing a midterm elections in November, and hence people are believing that there is going to be a change in the way Trump is handling or the way US policies are shaping up the global economics, and hence people are now starting to look at that the worst is behind us, and let's start to look at underperforming names, underperforming stocks, underperforming countries, and in seek that it will mean revert. And this is the reason why we have seen that interest is coming back to India. It is not very clear whether this interest has come more in the large caps or in the mid caps, but either way, doesn't matter. Till the time we are seeing positive inflows, it is good for the market and it's also good for the currency. All this selling, which we saw in the last 4 months, was absorbed by the domestic liquidity, which continues to remain strong. Not just SIP flows, even domestic direct investment in the equity has done well. For the retail in India or the mass in India, they have made decent returns in the mid and small cap market. That is fueling more money coming in, and now it has become a vicious circle. Bulk of the inflows that we see in mutual funds are coming in the mid and small cap segment, and that is what is fueling the returns on this segment. Seeing these returns, more liquidity is coming in, which again is going into the select stocks, and hence the whole mid and small cap basket in India is seeing vibrancy, and that is what has shaped the performance number that I was speaking to you at the start of the call. That mid and small caps are done well, and they have done well predominantly because of this liquidity. Going ahead, what is the call? We feel the domestic liquidities will continue to stay strong, though on the fringe of in the last few weeks and months. So we are seeing good amount of supply also coming in. Every day there is some kind of an IPO that is coming in. Very frequently we are seeing blocks of FIs or P guys booking profits, which is all getting lapped by domestic liquidity. So the money that is coming in is also getting sucked up in the IPO in the primary market, and hence not much of this money is moving towards the secondary market or the broad market. And that is the reason in your portfolios also you will see many stocks have not performed at all in the last 6 months or in the last 1 year rally, and some stocks would have done very well. They could be even 2x, 3x, not just from the March close, but from a 1 year or a 2 year perspective also. So what has happened is the rally has been very concentrated. It has been very selective. Only those sectors and companies where growth rate has not got impacted have done very well. And the broader market, whether it is mid market also, not all mid caps are performing in this rally, not all small caps are performing in this rally. So that's the way the market dynamics has run through. It's not been easy navigating through the turmoil, the news flow that we have seen, but somehow we have been able to handle the situation much better. If you look at the near-term performance across the three strategies that we have, which is the all-cap approach, which is a combination of large-cap and mid-cap portfolio that we have. You see the near-term performance, which is the numbers here. It has all picked up. It might not have that visible in the last 1-2 months, but overall, if you see the 1 year number, 2 year number, it has all picked up. If you look at the emerging opportunities portfolio also, the alpha generation year has been quite limited in the last 1 year or so. You see the whole index itself has not performed. It's just been a 2 to 3 year return kind of thing, and hence we are also broadly in line with the market. But here also in the last 6 months, we have picked up. Overall, last 3-4 years, if you look at the cumulative numbers, we have well above the market or the peer group. Last 1 year has been a struggle in the mid caps because it's been a very selective rally, and the bulk of the rally was in sectors or stocks where the valuation is already full or rich, and hence we don't want to blindly chase the momentum. When you don't do that, when you take the risk of near-term underperformance, which is already seen in our numbers over the last 1 year numbers, but we feel going ahead, once market stabilizes, which is a fair possibility once the Middle East crisis gets resolved, then the delta of alpha creation also will increase the way it has been in the past. And the third strategy that we have, which is the diversified alpha approach, which is the newest strategy that we have. That strategy also broadly over the last 1-2 years now has started to do well. What has contributed to this performance, as I mentioned, is one, avoiding IT, getting more into metals, and selective stocks which impacted our performance in the past. They all started to come back. Some have yet to come, but many of those stocks have started to come back. And it's a combination of these factors that has helped us in deliver what we have done so far. Going ahead, in the last 3 months, we have increased our pharma exposure. We'll continue to do that. On the fringe, we have increased our cement and you can say cap good exposure also. That also I expect the trend to continue. Financials, we are broadly where we are, but the preference today is NBFCs, then private banks, and then PSU banks, which was not the case earlier. 6 months back, we were equal between a PSU and a private bank, but today we feel that in the current environment where interest rate outlook is changing. Remember, 2 years back, we used to discuss how is it going to be the rate cuts in US, right? When it is going to happen, and Trump came in and he changed the Fed chairman saying that he's not cutting rates. Today, the whole narrative has changed, and in US also people are talking that there can be a rate hike to handle the inflation that they are facing. And same thing is happening with India. With a currency at 96, we cannot afford to have a lower interest rate. And hence rate cuts in India are also now no longer discussed. So keeping this scenario in mind, we felt that NBFCs are better placed because one, the growth rate here is the highest. They can handle the treasuries better than others, plus a decent growth rate, and hence the preference over NBFCs, followed by private banks and then PSU banks. So besides this, we are positively looking at the chemical sector. This is also one sector where selectively companies are benefiting from the currency depreciation or the export revenues are getting meaningfully, you can say, re-rated in that sense. So that is one segment that we are positively looking at. Domestic manufacturing continues to do well. That is a mega multi-year theme for investors in India. And we also would like to adequately participate in that. That is also one of the sectoral preferences that we have. We are not in a hurry to add IT names in the portfolio. Stocks have corrected, decent valuation. Yes, decent valuations now. For a value investor, it makes sense to look at these companies because they still generate a good amount of free cash flow. But we are still not looking at it for a simple reason that we feel every 3 to 6 months, all the AI modules that have come in, they all come for upgrades. You have version 1, version 2, version 3, and they'll this AI company will keep on expanding. So right now, if they have a product offering, say for 2 sectors, 1 2 months later, the same company will come and say, now I have a module even for the media sector. Now I have a module for the manufacturing sector. Now I have a module for the defense sector. Now I have also a module for chemical sector and so forth, right? So they'll keep on getting new models, which is going to be negative news flow for the traditional IT companies in India. Hence, we don't feel a reason why this sector should re-rate or outperform the broad market. It can be a market performance best what we see. So if market were to give a 10% return from year on, maybe IT will give you a 10 11%. It's not going to give you a 15 16% return. And hence, we are in no hurry to add IT names back in the portfolio. Traditionally, we never had new age companies in our portfolios because most of these companies were loss making, valuations were through the roof. People didn't value them on the traditional valuation matrices. It was always market cap to sales or what is the last round of funding and how much is the last P investor who is coming at what valuation is what used to determine the valuation in this sector. Things have changed as we speak over the last few years. There are now many platform and new age companies that are profitable and not burning too much of cash, and hence they are still generating enough of free cash flow. We have started to look at these companies. So earlier, though we are a bit late, frankly, if you have to admit, yes, we are a bit late in this sector, but at least now we are comfortable that we are not buying into a company which is burning cash, and soon that cash will go away. And unless and until there's a new investor who comes in at a higher valuation, gives you more capital, then you are in a soup, right? So at least we are convinced that we are not getting into that hope trade here. We will be looking only at profitable companies or companies where there is no cash burn, at least in the near term, is what the preference for us would be in the new age sectors. Uh, Besides that, uh, positive on the market, but not aggressive. We have been gradually deploying cash. Any new PMS investor who would be coming in the last 3 6 months, at least 15 to 20% of their portfolio would be on cash, waiting to be deployed, which we intend to do in case whenever there's a volatility in the market. Older portfolio guys are all 90% plus kind of invested, and that's where the broad numbers is. As you would be aware, at any given point of time, we keep strategic 4, 5, 6% cash in the portfolio. It's not a cash call or it's not my reflection of the market. It's just that we keep that buffer which we can use at any given point of time in a block deal or a trade or if something exciting comes up, right? And hence we keep that buffer. So while new guys have 20% cash, 6, 7% of that is the buffer cash that we always have. So incrementally 10 to 15% is what needs to be deployed, which we feel will do it over the next 3 4 months. November is the midterm polls in US. Trump is losing popularity, so it is safe to assume that he might lose it. If that happens, there can be a relief rally globally. But at the same time, it can also happen that Trump is also sensing, he is also seeing his popularity index. Before November, he could end up making 1 or 2 large decisions or policies or something that can impact markets. Already, what he is doing in the Middle East has impacted almost everyone. And it's a surprise to me as to why the world has not ganged up against the US saying that, boss, we can't do this. It's obvious what US has done. First, take control of Venezuelan oil, then you have a Middle East crisis, oil price goes up, you sell your Venezuelan oil at a higher price and you make money. Right? It's so obvious. It's not just India. China is a net energy importer. The whole of Europe is a net energy importer. Even Japan is a net energy importer. They have less impact than what India is because we import 90% of our requirement. These countries don't import that much, but they also net negatively impacted. So I'm surprised as to why everybody has not worked on to this and try to uh, put this thing into term that because of your policies and because of your action, we also suffering. What could be the agenda behind us? I also don't know. But looks like we are headed towards a scenario where things might take time. It's not going to happen suddenly in a hurry. But whenever it gets resolved, 1 month, 2 month, 3 month, due to the rapid investment in the renewable sector globally, we feel oil over the long term is headed lower, not higher. Maybe in the near term, we have to bear the pain. But eventually, because of the renewable spending globally, we feel oil is going to uh, trend down then up. And hence, we are quite over the long term positively inclined towards Indian equity markets, towards the economy per se. That's broadly what I wanted to discuss with you as to what we have done in the portfolio. How have we navigated through this? What is we intend to do as things stand today into the portfolios, and broadly how the market is looking to us. I'm sure there will be some queries you guys have both on the markets or on the portfolios. We are happy to address them now. We have SEBI concerns. We can't discuss individual stock specific discussions here. So please listen asking stock specific questions. But besides that, anything else, happy to address them now. So either you can put in your queries into the chat box and the moderator then take it up from there.
Thank you, sir. Thank you for the market outlook. So we have received few questions. So one of it is key. How has been the Q1 earnings, and what's your view going forward for the FY27?
So as I mentioned, the Q1 earnings have come in better than expected. When the March quarter results are coming, this is what the view everybody had, including us, that March is not reflecting the crisis of Middle East because it was just a month old in the month of just the month of March, and most of the companies had some either finished goods or raw materials, some inventory or some contractual obligations, and hence March impact was not visible in the March quarter numbers, and we felt that the same is now going to get visible in the first quarter. But so far, the earnings season has positively surprised. Very few companies have got negatively impacted by the higher freight or raw material or other issues. Most of the companies have done better than expectation. Obviously, there are some inventory gains also, but excluding that also, the ground level demand in India has surprised on the positive in the first quarter, is what I will say. Monsoon is deficit as of now, though rains are picking up and the deficit is narrowing. Hence, I don't think that monsoon is going to be a very big worry. It might have a halfway 50 pips or 70, 80 pips impact on GDP if it remains deficit for long. But that I think is something which is manageable. So unless it further deteriorates, I don't see any major domestic issue impacting the economy as such. Global is anybody's guess. So it's very difficult to take a call on the global market. So assuming global is normal, uh, I would expect the FY26 earning numbers also to overall then be on the higher side of the expectation. So if somebody is expecting 12 to 14% return, growth, uh, very likely that final number will be closer to 14 than it's going to be closer to 12. So that's broadly what we feel on the earnings front.
Sir, next question is on what's your view on IT sector?
Uh, More than 6 months back, we completely got out of this traditional IT services or holdings that we had in the portfolio with the view that one, growth rate was slowing down and the valuation was still pretty decent for a very low growth kind of sector. And also, there was buzzes happening on the AI front, which is going to eventually have a negative impact on IT services growth. That call so far has worked for us. Stocks are also down. Now we feel at least valuation is comfortable. There might not be immediate triggers in this sector, and there's always going to be this overhang of new AI companies and new models of AI company. Because of that reason, we have not yet looked back to reinvest in the IT, even at 30-40% lower price than what we sold on. We feel this sector would at best be a market performing sector, not a market outperformer sector, and hence we are in no hurry to get into IT. We continue to own product companies or new age companies or differentiated model companies within the IT sector, but not the traditional IT software companies.
So the next question is kindly tell us about the P valuation metrics. Currently, the Abacus all cap approach and emerging approach is there as compared to a BSE 500.
So I broadly showed you the performance numbers to how the these BSE 200 and BSE 500 matrices have done. On the earnings front, as per Bloomberg consensus, this segment is expected to grow between 15 to 18%. And from a portfolio standpoint of view, we are expecting the portfolio growth to be slightly higher than 20%, right? So the portfolio growth as such is much higher than what the broad BSE 200 or BSE 500 numbers are, because obviously we have picked and chosen companies that are growing better than what the average companies are doing, and hence the growth rate is much higher. And the good news is that we are not overpaid for this, in the sense that the portfolio valuations would be somewhere around 15, 16 times forward versus 18, 19 times for the market, right? So it's a decently balanced portfolio in that sense, where both the earnings growth is higher than what the market average is, and the PE valuation is lower than what the market average.
So next question is, as compared to a US where there's a more technology and AI opportunity as compared to emerging, which is probably a good time and where to invest type.
Yes, so obviously, global money is chasing global tech companies. That's where the maximum innovation is happening. That's where the maximum profit growth is happening. Unfortunately, we don't have much play in these segments now. But India has its own set of advantages, which is the domestic growth. So we are playing the domestic growth through the manufacturing sector or the engineering EPC cap goods sector, which are directly benefiting from the domestic growth story. Because of currency, some sectors are benefiting out of it, and hence we have increased our pharma exposure because of that. So that is one sector that also still continues to look good to us. So broadly, this is what the sectoral preferences that we have right now.
So next question is, what's the view on the new age companies and new age technology that have started getting listed also, and many of them are not part of our portfolio. So what's your view on that aspect, those sectors or new age technology companies?
We like most, if not all, many of these new age companies that have got listed. They all have great business models and great future potential. But having said that, you are right, not many of them feature in a portfolio, and that is predominantly because of the valuation concern that we have. Most of these companies are not profitable, and hence there is no P, and hence they get valued at EV by EBITDA or market cap to sales kind of numbers, which we are not very comfortable giving a very high multiple per se, and hence many of these companies don't end up coming into the portfolio. But of late, we have seen many companies either breaking even or started to generate a good amount of profit. Though near-term P looks high because of that, but at least they're not burning cash. We have started to look around at these companies. So uh, maybe a few months later, you'll see more of new age companies in our portfolio than what you see today.
So how has been the earning season as compared to a large cap versus mid cap versus small cap?
So season is still on. We are not yet concluded on the earnings season, but broadly, the mid and small cap has grown faster than the large cap, which has always been the case for many quarters now. Because of the lower base, the mid and small cap growth rate is higher than what the large cap growth rate is. So that trend has continued in the first quarter also.
So can you name few your preferred sector or where you are more bullish on?
So we already discussed the sectors that we are positive on: domestic manufacturing, pharma, uh, in cap goods, engineering companies, EPC companies. Tactically, cement can now start to do well. It has not done well over the last few quarters now, with prices coming off for the raw materials. There can be some benefit on the cement sector also. So this would be the sectoral preferences that we have right now.
So any particular view on private banks as they are trading probably closer to their all-time low valuation, but there's no potential growth, or what is the view on the private banking side?
So within the private bank, we are now preferring more mid-sized private banks than blindly buying the large-sized private banks. You are right. the valuations there are on the lower side, but they are still higher on an absolute basis. So what used to trade at 4 times book today has become 2 times book. But it is still 2 times book. It is not below book of 1.5 time book, right? So I'll say it is fairly priced now. And hence from a fairly priced stock, you expect a fair return. So maybe a high single digit or a low double digit return can also come in from the private sector banks. But if somebody needs to make an alpha, then mid-sized private bank would be the section to be in.
So view on chemical sector and specialty chemical.
Specialty chemical is pretty expensive still, in spite of whatever correction that they have seen since March. Uh, Bulk chemicals are looking good. Wherever there is a chemical export, and if you are competitive enough, then this sector, those companies are also going to be positively benefiting from the currency, right? So some currency gains are visible in the sector also. But one needs to be very selective. So while broadly we are positive on the sector, but exposure is pretty selective in that sense.
So view on defense and renewable energy sector.
There are not much of renewable players in India. Few select companies, predominantly in the solar and one or two companies in the wind space kind of thing. View is positive in the current scenario where oil prices are high, and what when the world has seen oil price shock, I am sure that governments globally will have to be pro-renewable, and hence the government policies should remain pro-renewable in that sense, and hence the view on the sector is positive for us. Defense, as I mentioned, good growth opportunity. Next 2 to 3 years are going to be bumper for many of these companies. But in most of the cases, if not all, the current valuation, the current prices adequately factoring in this upside, the growth potential that these companies are. So one needs to be again positive but very selective in what they get within the defense sector.
So view on fertilizer and cement sector.
Cement can be a tactical, but last year and a half, stocks have not performed. Industry is now fairly concentrated in that sense. Uh, we had felt earlier that there will be pricing discipline and pricing hikes because now good amount of M&A activities is behind us and the leaders need to generate decent amount of ROE to be able to justify the acquisition that they have done and the price that they have paid, kind of thing. So far that has not happened, and then in the near term, coal prices went up or the raw material prices went up because of higher oil prices. So that is going to impact them in the near term. But I believe from the second half of this year, things will start to look positive, and hence that is the time when this stock or sectors can do well.
So last question. So it's a two-part question. So part one is uh, for investors who have invested in any of our PMS, that is all cap or emerging opportunity or diversified alpha, over a period of last 2 years. This is the first part question. Second part is if any of the investors want to invest today in any of our strategy, whether it be all cap, emerging or diversified alpha, what is the view? So part one question is investors who have invested 2 years ago, what they can see in the coming 1 or 2 years. And similarly, if any investor are coming now, what's their view and thought process?
So both part one and part two indirectly are asking the same question, that whether going ahead mid caps will do well or large caps will do well, right? Because that will answer which strategy the investor will come in, whether it is an existing guy or a new guy. Frankly, we don't think this way while we invest as to whether the call in the market is mid cap versus large cap, or whether large cap will do or mid cap will do well. For us, being the right stocks between the both the sectors is the key is, because within large cap also, since we are completely unbenchmarked, we look to generate an alpha in the segment, and within mid cap also we try to do that. At any given point of time, there will be some segment in the market where valuations are frothy, where there is momentum. It can be in large cap, or it can be in mid cap, or it can be in small cap also. So one needs to avoid that. So that's the way we think that we should be in right stocks rather than trying to see whether mid caps will do well or large caps will do well. I think this is an answer a best investor can answer for himself, is because it also depends on what his risk profile is or what his risk mandate is. If he has a 3 to 5 year view and the money that he's investing is surplus money, which is not going to alter his lifestyle in the near term, then making an investment into a mid-cap portfolio makes much more sense because it's simple maths. On a lower base, these companies can grow faster and hence can command a better multiple and a better return versus the large cap. Obviously, they are more volatile, so one needs to be careful of that also. So if somebody has the stomach to handle the mid-cap volatility, then over a 3 to 5 period, I believe mid and small cap can give you a better return than a large cap. But if somebody is not okay with the volatility risk that the mid-cap carries, then obviously he has to find a balance between large caps and mid-caps. He cannot be just a large cap investor because that is one segment which, from a market return perspective, is not going to give you the best return. So there can be some quarters, there can be some time when there is mean reversion after 3 4 years of good mid cap performance. Maybe 1 year large cap will do well, but eventually over a 3 to 5 year period, I believe mid caps can give a better return than large caps.
Okay, sir. So that was the last question. Any closing remarks?
Good, good. So thanks everyone for joining us. I know it's pretty volatile times and pretty uncertain times. We also, in fact, facing the same uncertainty. Hence, we thought it's appropriate to share the current view that we in the market. How are we navigating the times? Uh, the unfortunate part is that much of this uncertainty is global, where we are like we can't preempt, we can't predict, we have to just react to what happens. Had it been local uncertainty, we can still model something. Then fine, this is the way economy is, this is the way things are shaping. This can be positive, this can be negative, and you can work towards it. But when it is global uncertainty, it is very difficult, and that is the reason we are not very aggressive in the market. We are positive. We uh, are looking forward to a better return from the market than what has been the case where the market has been sideways for more than a year now. But at the same time, not very aggressive just because of this global in uncertainty kind of thing. Once things are better, it will never going to be 100% certain. But once things are better, I believe the relative underperformance that the Indian markets have seen will mean revert and we'll see good returns coming in. So keeping that in mind is what the whole investment mindset and the portfolio construct is what we are going through in all the three strategies that we have. So that's broadly what I would like to conclude on. Once again, thanks for joining us, and have a great day.
Thank you, everyone. Thank you everyone for joining. Good evening. Thanks.